I am Mark.
And I'm Sarah.
Welcome to our analysis from the Higher Wire podcast.
Today we are examining some really critical labor market figures from the very end of 2025 and the start of 2026.
Right, this data is essential because it really maps out the landscape that you, as recruitment professionals, are navigating at this very moment.
And for our analysis, we're extracting some key insights that show how worker priorities are shifting.
And how those shifts, combined with, underlying economic pressures, are fundamentally changing the hiring climate.
A lot of our perspective today is guided by some truly foundational analysis from industry legend Bob Marshall.
Yes, his December 2025 reports are invaluable. They draw from his decades of experience just watching this data.
So let's start with the worker mindset. It's revealing some deep risk aversion in the talent pool right now.
It really is. The Monster 2026 WorkWatch report, which just came out, showed a dramatic collapse in planned job searching.
The numbers are pretty stark. Think about this. In 2025, a huge 93% of U.S. workers said they plan to look for a new job.
And now, for 2026, that number has fallen to just 43%.
That is a drop of more than 50 percentage points. It signals a fundamental change.
It does. The optimism and the high mobility of the past year seem to have been replaced by a kind of realism.
So workers are prioritizing sustainability, protecting the stability they have.
Exactly. It's about managing personal risk, not necessarily betting on new market opportunities.
But that said, there's an interesting conflict when you look at the Robert Half data from December.
Right. That survey showed 38% planned a job search in the first half of 2026.
Which was actually an increase from the year before.
Yeah.
So what should recruiters take away from what looks like a contradiction?
Well, I think the difference is in the nature of the intent. The Monster data captures that general market feeling. Most people are sitting tight because of uncertainty.
Okay.
But the Robert Half data suggests that the smaller group who are ready to move are very committed. So you have a higher density of serious candidates.
So the takeaway for recruiters is that passive talent, that 57% who are not planning to search, are now exceptionally harder to pull away.
Much harder. And those serious candidates, they're being very clear about their demands.
The Monster report breaks it down. 3 main priorities. Salary increases are number 1 at 73%.
Unsurprisingly. Followed by flexible work schedules at 58%.
And better work-life balance at 54%.
And that demand for salary is a direct reflection of inflation. 58% of workers are concerned their pay won't keep pace.
And 57% said their wages have already fallen behind.
Which means any successful recruitment pitch has to start with a really competitive financial offer, not just the softer benefits.
And beyond money, wellness is a huge factor. 40% of workers are citing concerns about burnout or mental health.
Which feeds directly into that demand for balance and flexible scheduling.
And this brings us right to the return to office mandates.
The RTO trend is definitely solidifying. 50% of workers are now required to be on-site 5 days a week.
This is becoming the default for a lot of large corporations.
It is, and this is where the talent pool just shrinks for those companies. 31% of workers say they would not even apply for a job that requires 5 days in the office.
So for a recruiter, that means a third of your professional talent is immediately off limits if your client has a strict RTO policy.
Absolutely.
Yeah.
The direct consequence is that roles with genuine flexibility, they're suddenly seeing disproportionately higher applicant volumes.
Which can complicate screening, I'd imagine.
It can, but it also creates a premium talent opportunity for organizations offering, say, a 3 or 4 day hybrid model. That 5-day mandate is becoming a significant competitive disadvantage.
And then layered on top of all this, you have the anxiety around automation.
A big one. 49% of workers are concerned that AI could threaten their job or their entire industry.
But that concern is driving some positive adaptive behavior.
It is. We're seeing 64% of workers planning to pursue upskilling or some kind of training in 2026, and 30% plan to start a side hustle.
So they're actively mitigating financial risk by increasing their skill value and diversifying income.
Which makes them more financially secure and therefore harder to recruit passively.
Okay, let's pivot from the worker mindset to the hard labor metrics from December 2025. The overall jobs picture was, well, stable but trending slightly up.
That's right. The Bureau of Labor Statistics reported total non-farm payroll employment was up slightly, by about 50,000.
And the unemployment rate held at 4.4%.
And the ADP report confirmed that for the private sector with a net increase of 41,000 jobs. But the really interesting story isn't the total number.
It's the disparities within it.
Exactly. Extreme disparities by sector and by company size.
We saw the service sectors leading the way. Education and health services added 39,000 jobs.
And leisure and hospitality added 24,000.
But the losses were concentrated in those high-wage, white-collar sectors. Professional and business services shed 29,000 jobs.
And the information sector, which covers a lot of tech roles, lost 12,000.
That pattern is vital for recruiters working on corporate placements. The growth is not uniform.
And this is where one of Bob Marshall's great insights on establishment size is so useful. Over 96% of that new private sector job creation came from small and medium-sized businesses.
So what's the strategic implication there for a typical recruiting firm?
Well, Marshall reminds us that these smaller companies, the ones that often don't have big in-house TA teams, they are the absolute bread and butter of the contingency side of recruiting.
So if you're only focused on Fortune 500 hiring trends, you're missing where most of the growth is actually happening.
You're missing the majority of it. Recruiters need to be shifting their business development focus to firms with, say, 50 to 200 employees.
Now, regarding compensation, there's a clear penalty for staying put.
A very clear one. Median pay growth for job stairs was flat at 4.4%.
But for job changers, it accelerated to 6.6%.
That 2.2 percentage point difference, that is a clear, measurable financial incentive to move, even with all the risk aversion. Recruiters need to emphasize that arbitrage.
We also saw a disparity based on employer size. Pay growth at large firms was higher.
Right, at 4.8%, consistently outpacing the smaller firms. At the smallest companies, 1 to 19 employees, it was only 2.3% growth.
We also have to mention the sustained contraction in manufacturing.
Yes, the ISM Manufacturing Index shrank to 47.9 in December. That's 10 straight months below 50, which signals contraction.
And we haven't seen that kind of sustained shrinking since early 2024.
No, and it's deep-seated. Producers are pointing to major headwinds, tariffs, elevated material costs, and just depressed business activity because of high interest rates. It makes long-term planning very uncertain for them.
Okay, shifting gears. Let's talk about what this means for the immediate recruiting process. This is all about the skills-based market.
And there's a deep contradiction here between what employers want to do and the candidates they're seeing.
An Express poll found 85% of hiring managers have a positive outlook for 2026. 66% plan to increase headcount.
Which is the highest level of intent we've seen since 2020.
But that optimism is hitting a wall. 36% of those hiring managers have open positions they simply cannot fill.
And the obstacle isn't a lack of applicants. It's a lack of qualified applicants. 50% were cited as lacking relevant experience. It points directly to a skill gap.
This confirms the observation from LHH. We are in a skills-based market. Road experience is less valuable.
Candidates have to position themselves by showing adaptability, agility, and, most importantly, learnability.
LHH had a great example of this shift. They said employers aren't just looking for coders who know Python anymore.
Right. They're looking for engineers who understand how to integrate and work with AI tools. The specific hard skill is secondary to the ability to evolve with technology.
And we are seeing that evolution happen. 58% of candidates in career transition are pivoting to entirely new occupations.
Which reinforces the need for recruiters to look beyond just job titles and assess transferable skills.
But this creates a new challenge for candidates, doesn't it, in how they present themselves?
It does. While you should use tech tools like AI to polish your resume, it's creating what we're calling a sea of sameness. Everyone's resume is optimized for the same keywords.
So how does a candidate break through that?
Differentiation. If AI handles the technical terms, then the human skills become the true differentiators. Things like strategic thinking, communication, quantifying your impact.
Showcasing that learnability we mentioned.
Exactly. Recruiters need to be coaching candidates on how to position those uniquely human traits.
This brings us to one of Bob Marshall's most important insights, this one on market depth, which comes from the BLS JOLTS survey.
Yes, the Job Openings and Labor Turnover Survey. When recruiters see that number, say 7.1 million published openings in November 2025, the market might seem manageable.
But Marshall reminds us that relying only on published openings is a massive mistake.
A huge one. Those 7.1 million listings represent only about 20% of the true job market.
He calculates the total, published and hidden, to be a staggering 35.5 million job orders.
This hidden market includes roles waiting on budget approval, roles that will only be filled by referral, or positions clients have just given up on listing.
So the implication for recruiters is clear. Your value is in uncovering those other 28 million opportunities.
Precisely. Through networking and proactive outreach, your value is accessing the invisible market, not just the advertised one.
Okay, let's conclude with a core misconception that Bob Marshall consistently emphasizes. He says that overall unemployment rates are practically meaningless for professional recruiters.
They are. That national rate of 4.4% doesn't represent the challenge in acquiring specialized talent.
We have to look at the specialized unemployment rates.
Right. In December 2025, the rate for management, professional, and related workers was a very tight 2.4%, down from the month before.
And for college-degreed workers, it was 2.8%.
These extremely low numbers force us to consider the economic concept of professional full employment.
This is Milton Friedman's theory, the natural rate of unemployment, or AIRU. It basically says a healthy economy will always have some unemployment, maybe between 4 and 6%.
And when Bob Marshall applies that professional threshold to the current rates, 2.4 and 2.8%, it's undeniable that these sectors are far below the natural rate.
So it effectively translates to a state of no unemployment in the sectors where recruiters focus.
The talent pool isn't just constrained, it's effectively exhausted of people who are actively seeking work.
So given that severe tightness, what is the clear strategic imperative for recruiters?
Bob Marshall's reminder here is essential. Because the professional market is so tight, recruiters must focus relentlessly on two things. First, you must market to find the best possible job orders that give you a competitive edge. And second, you must recruit candidates who are happy, content, and currently working.
You're not filling roles with the unemployed. You're headhunting successful talent.
That's the job now. You're persuading successful people to make a change.
So to wrap it all up, workers are balancing ambition with risk, RTO and inflation are driving the few who do move, and employers are optimistic but facing a severe skill gap.
And all of this is happening in a market for professional talent that remains exceptionally constrained, confirming Bob Marshall's great insights on this sustained, intense demand.
Before we go, let's leave you with one final thought to consider. The economy is actually quite strong. GDP increased at an annual rate of 4.3% in the third quarter of 2025.
And unemployment changes usually lag GDP improvements, which suggests this professional market tightness is only going to intensify.
However, there are frequent reports that key federal data agencies, like the BLS, are struggling with capacity, with staffing, and with an erosion of public trust due to resource constraints and political actions.
So consider this. How might the integrity and the timely release of reliable economic data influence corporate investment and hiring decisions? When you, as a decision maker, have to rely on figures that are often delayed or substantially revised months later.
That uncertainty adds a complex layer to any forecast, one that relies not just on the health of the economy, but on the government's capacity to measure it accurately.
Something to think about as you plan your strategy for the coming quarters.